Howdy, folks. Welcome to the weekly economic update. It is Monday, September 26th, 2022. Hope everybody had a good weekend out there. Astros they split the series with Baltimore and swept Tampa over last week. So good, decent road trip for my Stros. Texans played pretty terrible yesterday. I didn't really watch any of the game because the Astros were on. So anyways, if it's your first time watching, please give me some big old thumbs up, like, shares, subscribes, all that good stuff. I would greatly appreciate it. And another ugly day in the market, but again, not really to be expected. We talked a little bit about this on the Friday broadcast. So let's go ahead and jump in and take a look and see how they did today. Dow Jones was down 1.1%, closed at 29,264. S&P 500 down 0.96, closed at 3657. NASDAQ down 0.6, closed at 10,802. Small caps were down more than 1%. The VIX was up 8.05% today. It's currently at 32.33. The other exchanges here in the Americas, Canada down 0.83, Brazil down 2.14, Mexico down 1.25. Jumping over to Europe, Germany was down 0.46, UK was flat at up 0.03, France down 0.24, the Euro Stoxx down 0.18, Netherlands up 0.18, Spain down 0.99, Italy up 0.67, Switzerland down 0.64, and Portugal was down 1.3%. In Russia, they were down a bunch today. The MOEX was down 7.49, while the RTSI was down 8.62. Moving over to Asia, looks like they had a pretty bad day too. Japan was down 2.66, Australia down 1.6, New Zealand, one of the bright spots, up 0.39. In China, the Shanghai down 1.2, the SESE component down 0.4, the China A50 basically flat at up 0.07, DJ Shanghai down 1.04, and the Hang Seng down 0.44, and the Taiwan weighted was down 2.41%. So pretty ugly day for the markets all around. Again, not really that surprising. All righty, well, let's go ahead and read through today's weekly economic update. Last week, Fed Chair Powell said the U.S. would not tame inflation without economic pain. This week, heightened recession fears and sent stocks broadly lower. The Dow Jones Industrial Average dropped 4%, while the S&P 500 lost 4.65, NASDAQ fell 5.07, and internationals declined 3.05%. Yields surge and stocks tumble. Last week's meeting of the FOMC proved unsettling for the financial markets. It wasn't only the widely expected announcement of another rate hike, but a more hawkish message that the Fed, that rates may be heading higher for longer than anticipated. Fed officials indicated that any policy change might be further off than investors had contemplated. The latest rate hike caused bond yields to rise, with 2-year and 10-year Treasury note yields touching levels not seen in over a decade. Global central banks moved in tandem with the Fed as the Bank of England, Swiss National Bank, and Norway's Norges Bank, among others, also hiked rates. Another rate hike. In its efforts to cool inflationary forces, the Federal Reserve raised rates by 0.75 of a percentage point last week. The third consecutive rate increase of that size. Projections by FOMC members suggested that interest rates may increase by as much as 1.25% before the end of the year. The FOMC also projects that unemployment will rise to 4.4% by December of 2023. This projection is up from the current level of 3.7%, and that core inflation will be 4.5% by year end. In June, the Fed officials projected core inflation would be 4.3% by year end. They also indicated that interest rates may reach as high as 4.6% in 2023, without any rate cut likely until 2024. So not the best news. We're going to have to continue this diet of higher interest rates to try and quell the inflation we're dealing with. Economic data coming out this week. Tuesday, we have durable goods orders, consumer confidence, and new home sales. Thursday is jobless claims and GDP, and Friday is consumer sentiment. Got 4 companies reporting earnings this week. Wednesday is Cintas and Paychex. Thursday is Micron and Nike. All right, so that's everything there. Let's go ahead and read through today's market recap. S&P 500 in U-turn as rising Treasury yields bite. The S&P 500 paired some gains Monday as tech eased from session highs amid concerns about increasingly hawkish Federal Reserve at a time when the slowdown in the economy is expected to pick up pace. Tech gave up some of its intraday gains, pressured by an ongoing climb in Treasury yields as Fed members suggest measures to slow growth, including rate hikes, increase the chance of the economy falling into recession. Atlanta Fed President Raphael Bostic said the Fed, quote, still has a ways to go, end quote, to bring down inflation. Bostic's remarks come hours after Boston Fed President Susan Collins said higher unemployment would be needed to help curb inflation. The U.S. 10-year Treasury yield climbed to nearly 4%, while the 2-year climbed to about 4.3%, a 15-year high. Apple, however, weathered the storm of positive commentary on iPhone demand from JP Morgan. JP Morgan cited the Wave 7 August survey showing Apple's new product line is expected to fare better than the iPhone 13. Chip stocks also added pressure on the tech sector, driven by NVIDIA, AMD, and Micron Technologies, down more than 1%. Utilities, a bond proxy that is less attractive in a rising rate environment, also played a role in the market sell-off. Energy fell more than 2% as oil prices continue to tumble on worries that worsening global growth will further dent energy demand. Quote, at current levels, it appears the market is now pricing in typical impact of a deep recession, end quote, ANZ Research said in a recent note, though added that the sell-off in oil could see OPEC intervene again. Halliburton Company, Oniok, and Baker Hughes fell sharply, with the latter down about 5%. Consumer stocks, however, were the relatively outperforming sector on the day, lifted by a surge in casino stocks after Macau said it would resume visitation access from mainland China through tours and e-visas. Las Vegas Sands, Winds, and Melco Resorts were up double digits. In other news, PG&E was up more than 1% as the company is set to replace Citrix systems in the S&P 500. So kind of a mixed bag of news. Some things were up, some things were down. The dollar index right now is sitting at 114. It went up 1.045 today, or almost 1%. So the dollar continues to climb, which is putting downward pressure on a lot of commodities out there. So that's probably the bigger reason you're seeing oil prices go down, and same with your precious metals and things like that for the short term. All right, next up, just a article came from John Malden. It's Notes on Inflation is the title. Just wanted to cover a few different sections here. Starting out, price inflation is an individualized experience based on your spending patterns. It is increasingly difficult to escape completely, though. Almost every category of living costs is rising to some degree. You can see it in these charts from my friend Liz Ann Saunders of Charles Schwab. And you can see here where fuel oil is up around 70%, gasoline about 30%, and a bunch of things. Most of these are 5% or more than they were year over year. So again, things are still expensive out there. The food component of CPI just posted its biggest annual jump since 1979. You can see that here in this chart. Again, something we need. Just like oil and gas and energy products, food we need. So it's really hitting people hard in the wallet. And then also some shrinkflation. Most businesses hate rising prices. At some point, they have no other choice. But it's nerve-wracking because they don't know how customers will respond. So they find all manner of ways to camouflage what they're doing, hoping no one will notice they are paying more. Anas Alhaj recently posted some examples of shrinkflation when companies keep prices the same but reduce the quantity sold. So for like Folgers coffee from 51 ounces down to 43, Kleenex 65 tissues down to 60, Doritos 9.75 ounces down to 9.25. Let's see here. Burger King chicken nuggets, 10 down to 8. I mean, what are teenagers going to do? Bounty triples, 165 down to 147. Ice cream, Tillamook from 56 down to 48. And you kind of get the picture. So this is kind of what we're dealing with. Also, with this week's 75 basis point hike, the federal funds target rate is 3.25%. Annual inflation is running at 6.3 for PCE and 8.3 for CPI. That means the real Fed funds rate is still deeply negative, somewhere between negative 3.05 and negative 5.05, depending upon which inflation figure you use. And here in this chart, it shows all the different inflation rates, what their central bank rates are. And you can see here, America at, when this was printed out, was at 3.13. And we currently have 8.3% inflation. So we're currently sitting at 5.2. So very few countries out there have a positive central bank rate. Hong Kong at 0.9, their inflation's only at 1.9, and their rate is at 2.75. China, well, and again, trust the Chinese data as much as you want. They have a 1.2% positive rate. Their inflation rate is 2.5, and their central bank rate is 3.65. Saudi Arabia has a positive 0.8. Their inflation is running at 3%, with their central bank rate at 3.75. And then the other positive was Brazil. Their inflation rate is 8.7, but their central bank rate is 13.75. So again, most of these countries are in the red by considerable amounts. Like the Czech Republic's at -10, Turkey's at -68. Let's see, Thailand -7.1, and so the Eurozone -8.4. So it seems like the areas that did the most quantitative easing and bailouts and things like that are really feeling it the worst. Places that kind of steered clear of that are faring much, much better. All right. And last thing I got here was a video / podcast I listened to over the weekend. It was on the Part of the Problem from Dave Smith. His guest was Scott Horton, who is what I would consider an expert in foreign policy. And we're going to listen to 2 or 3 minutes of them talk about what's going on in Russia-Ukraine situation right now. And I would encourage you to watch or listen to the entire broadcast at your own leisure. It's really good. Scott's always great with information and such. So let's go ahead and make that bigger. There we go. And let's give this a listen. So.
Russia's territory is threatened at all, he will use nukes. Now, I recommend people go over to antiwar.com, read all this stuff. I always suggest people go check that out. But tell us, Scott, what exactly is going on with this?
Well, look, I mean, the worst part of that, I mean, what you just said is absolutely accurate, but he's also expanding the territory of Russia. He is, right. He's announced he's holding these referendums, these plebiscites, which there's no reason to presume their legitimacy in any way, but whether you like them or not, regardless, they're the pretext for him to reabsorb the southern coast of Ukraine into the Russian Federation, into the old Russian Empire. And so it's a matter of days or weeks. He's officially, before it was the independence of the Donbass that he was securing. Now he's going to formally annex the Donbass, Donetsk and Luhansk, but he's also talking about Zaporozhye, which is above Crimea, north of Crimea. And I'm sure I'm pronouncing that wrong, but it's sort of like that. And Kherson as well, which is northwest of Crimea on the way to Odessa. And from there, it ain't far to Moldova. And it looks like, I don't know if they're going to take Odessa or not. They very well could. But he's announced essentially that he is annexing the far eastern regions of Ukraine and the southern coast, at least all the way to Kherson. So if that's the case, I mean, we're talking about legal fictions here anyway, these lines on maps here. Sure. So if in 2 weeks from now, or 3 weeks from now, after these, plebiscites have been held and the paperwork has been shuffled, and Putin is saying that this is now Russian territory, then it sounds like what you just said applies to any Ukrainian government attacks, even on Russian forces in Kherson or in Zaporozhye or in the Donbass or any of these places that were considered Ukrainian territory as of today, although under Russian occupation. So, they keep saying that this guy is the most dangerous psychopath on the planet. Maybe he is. But they keep trying to push their luck. And, this whole thing, as I've told the story before, was essentially brought on by American interventionism in the region and our refusal to negotiate, the Biden government's refusal to negotiate in good faith with Putin after provoking this crisis 1 year ago by bringing Zelensky to DC and inviting him to join NATO and having the State Department issue new papers and reports about the process of integrating Ukraine into NATO and all this going forward, which is what led to the buildup and all the heightened tensions and led to the war. So, essentially the argument of the hawks the whole time. I swear to God, it's like 20 years ago with Iraq, where just the hawks are so full of it, but they're so right and so self-righteous. Just no one can contradict them. Like Kathy Young in that debate at PortFest, where she's saying, how can we not support the Ukrainians by giving them these weapons to fight when they want to fight, when all we're doing is getting them in worse and worse and worse and worse trouble. And we know now, we already knew that the Ukrainians and the Russians were negotiating in April when Boris Johnson, the Prime Minister of Britain, intervened and stopped them and threatened the end of all American and British support if they continued. Obviously, at American behest, he did that. Well, now we know, extra confirmed from Fiona Hill, the hawk, writing in Foreign Affairs, that they had an agreement in principle, essentially in pencil but not pen, hand shook but not signed, saying, okay, this is the deal. And the Russians were willing to withdraw all the way out of, to positions from before the war, back to Russian territory, as long as the Ukrainians would be willing to recognize, this enhanced autonomy, essentially respect Minsk II and the enhanced autonomy of the Donbass, and forswear membership in NATO. And so they had it.
All right, we'll go ahead and end that there. So, like I said, it's a little over an hour long, but definitely a good listen. And Dave is someone that I actually pay money to subscribe to his podcast because it's got such good material, and I like supporting fellow libertarians out there. So, all right, well, that's everything I had for today. I hope everyone has a wonderful Monday evening. I'll be back tomorrow with the Liberty Call. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. And I hope everyone has a wonderful night. Bye-bye.